Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, May 30th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. This something very sad happened over the weekend. I wouldn't even be doing these videos right now, and Revere Asset probably wouldn't even exist if it weren't for the legendary William J. O'Neill, founder of Investors Business Daily and author of How to Make Money in Stocks. And after a long fight with dementia, he finally passed away after a long fight. And no, I'm he's as wonderful as he was as an investor. He was even that much better as a person. I'm pretty plugged into the community and the stories that people can tell about just the unbelievable kindness that Bill would exude toward anybody. Never made anybody feel smaller than he was, even though he was an investing legend. Once he found the secret to the market, he could have kept it to himself and lived a very simple, wealthy life, but that's not the guy he was. He wanted to empower individual investors because he saw quite well what uh, what could happen to them uh, in bad markets and how it could change their lives in good markets if they found the right stocks and handled them the right way. And um, I can't say enough about the guy. Was fortunate enough to meet him 4 or 5 times, and uh, out in uh, out in California at the Masters programs that they put on, and the guy is just a legend. And like I said, it's a testament really to him as just a fantastic person, in this addition to just a wonderful businessman and master of the market. So rest in peace, Bill, and thanks for everything you've done, not just for me and Revere, for the inspiration along the way, and how you lifted up so many thousands of investors. And our clients benefit from it. I benefit from it. Our firm is. Everybody involved with Revere is. And like I said, we wouldn't be here without him. So let's get into it. State of the market. We're in a large cap tech led uptrend, continuing to avoid the laggards, commercial real estate, and regional banks. You can see over here on the trend gauge, market leaders in an uptrend. Short term, we're in an uptrend led by the Nasdaq 100 and the tech-heavy S&P 500. Weakness continues in Dow mid caps and small. 50-day moving average. This is our medium-term indicator. S&P and Nasdaq 100 again firmly above, bringing up the rear. Dow and mid caps and small caps trying to make a little bit of a run, showing some relative strength, at least recently, versus the Dow and mid caps. Long term, the 200-day moving average, all three of the big cap indexes are above there. The Dow bounced at the 200 last week. Mid and small cap still struggling, but trying to make an effort. So what happened today? Over the weekend, debt ceiling agreement between uh, the the majority leader, Republican majority leader McCarthy, and the White House. Now it needs to pass the Senate and the House of Representatives, and it appears that both the far right and the far left are upset with the deal. So that means it probably will pass with votes from the middle. The market showed some exuberance overnight with a nice sized gap up of 0.5%, but that quickly faded. Uh, all We gapped up 0.5% on the S&P, 1.3% on the Nasdaq 100, but uh, leaders also gapped up, especially a bunch of AI leaders. And this was just a little bit of irrational exuberance today, as most of them faded. Some of them put in nasty reversals. Some of them held on to most of their gains. The bottom line is AI becoming a very volatile trade. Um, we're convinced it's just in the beginning of the opportunity to make money, but it's how you handle the individual names that you're in that will result in your success and or failure. And that's frankly the case with any volatile small to mid cap growth leader. So here are the final numbers on the day. RG8, this is our 8 ETF composite, up 0.15%. S&P 500 just barely positive. NASDAQ 100 led the way, up 0.45%, but more than a percent off the highs. Dow Jones Industrial Average down 0.15%. Mid caps down to 10th. Russell 2000 down 0.32. But actually, somewhat of a rally off of the lows on all the indexes after the sell-off. So not a complete flush and close at the lows and inflict fear for tomorrow. In fact, we pulled back to a very reasonable level on the S&P. The Nasdaq is extremely extended and somewhat at the whims of buyers and sellers of the top 7 stocks in there. Global Diversified 60/40 stock and bond up 0.04%, led by bonds as yields came off today after the debt ceiling agreement. In-house GROTECTION up 0.19%. Some portfolio changes today. I'll detail those when we get to the tail of the tape, and it's also Titan 25 Tuesday. The market can't fall apart as long as these key 25 stocks that have large weightings across the S&P, the NASDAQ 100, and the Dow continue to keep it together. So let's get right into it. We'll start with the S&P 500. You can see closing near the low of the range, but right above this 4,200 level. That was the fortunate thing that happened today. So let's go to this 30-minute chart, and you can see the big gap up. Very early, we topped. Lower highs, lower lows, pretty harsh pullback, and under that key 4,200 level. But we regained it mid-afternoon, tested it several times into the close, and it held. So for now, this is a win for the bulls. You get extended, you pull back, but you hold support. Anytime you hold a key support area on a pullback, it's a win for the prevailing trend, which is clearly higher on the S&P and the NASDAQ 100. So that's a key area that we'll be keeping an eye on is 4,200. When we get to the tail of the tape, I'll show a key fib level above 4,300 that we're watching as resistance. And then, of course, you've got valuation issues with the S&P 500. And Michael did a pretty nice dive and discussed it in our afternoon call about the market is not overpriced. If you take out those big 7, the S&P is about at 3,800, which gives it a decent multiple for most of the remaining sectors. So there's your S&P 500. Win for the bulls, a win against irrational exuberance lost, let's say that. And speaking of irrational exuberance, here's the NASDAQ 100, which got extended above the 50-day moving average by over 10% at the highs today. Let's take a look back at a couple of prior times when it got extended that much. Right here, the beginning of February, we peaked at 11.1% above the 50-day moving average and then proceeded to pull back. Here was a more reasonable peak at 7%. That's usually about the outside of a normal situation where you're extended. Back here with the move up in August of last year, we got as high as 3 days. We spent between 10.7 and 11.4% extended above the 50-day moving average before a very harsh pullback. That was the bear market, and we were trying to decide rally. We had actually ended up having a third leg down after that. I don't know how comparable that is, but when we got this extended and started to come off, we put on a hedge against the NASDAQ 100. We may lose money on this hedge, but it'll offset the longs that are also extended that we want to stay in until they get a little less extended and start to act a little bit more normal today. Certainly with the third day up and a gap and then the reversal, the market's calling a little bit of a timeout for these NASDAQ 100 and big AI stocks. Not all of them, but some of them. Let's go to the Dow Jones Industrial Average, which held the 200-day moving average last week. Inside day today versus Friday. So consolidating that move off of the 200-day moving average, which is at 32,772. That's a level we want to hold on any pullback. The relative strength continues to be just awful on the NASDAQ 100, or sorry, on the Dow. So looking for some reprieve there. A lot of oversold stocks in there. Let's go to mid caps. Tried to make a breakout last week and Friday the week before, failed, pulled back at the 200. Now today we got above the 50 and the 21 and failed. So this 450 area continues to be a key level of resistance, just like it was a key level of resistance back here in March, turned into a support in April. And since this pullback, it's been acting as resistance, unable to get above it. All the moving averages, the 8, the 21, the 50, and the 200 are all stacked up here within a couple of percent. Moving through that 452-ish area and back testing 450 and holding it is what we want to see for mid caps. Mid caps are the incubator for the next big growth leaders. IWM here, small caps soundly rejected at the 200-day moving average during last week's rally. Pulled back for 2 days, rally on Friday, gap up today, reversal, but holding the 200 or the 50 and the 21-day moving average. So a little bit of a bonus there. Coming off of overbought and coming down, so expect the possibility of a little bit more sideways action here before another run at this 180 level and the 200-day moving average. Let's check regional banks. We haven't looked at this chart, I think, in a couple of days. It's just trying to um, find a level that it can build a base off of. So you can see the harsh move, the third harsh move down, this abandoned baby bottom that we tested and held. Sharp move off of there, ran into the declining 50-day moving average. Now 4 days consolidating right along this 21-day moving average. That's good stuff here. So if we can keep the regional bank issue out of the headlines, get back above, hold this 21, get back above the 50-day moving average. This will give a big lift to mid caps and small caps. Where are we now? Let's go to the VIX. The VIX, with the fears last week on the debt ceiling, we got above that, up to that 20 level and above. That held. Now pulling back the last 3 days, back below the 21-day moving average. The VIX doing its job. It's reflecting the actual true volatility of the S&P 500, whether people want to believe that or not is up to them. UUP, the dollar, consolidating for a second day after a very strong run up off the bottom. Bulls want to see further pullback in this, especially if you're a bull in precious metals. Let's go to them. GLD, positive on the day, bouncing off this 180 level. GDX, gold stocks, closing near the lows of late last week, so no progress there, down 0.7%. Silver down 0.37% last Thursday, possible washout low holding for right now. Let's flip the bonds. The broad bond index up after 2 weeks basically straight down, a bounce into the moving averages on the debt ceiling. It is oversold. This can run higher. TLT, the 30-year, up 1% as it held that 100 level, tested this abandoned baby back here. Baby back, baby back, baby back. Let's go to the actual yield itself, TNX. 10-year, nice run, 2 weeks, gapping down, yields pulling back on the debt ceiling agreement. We're in oversold territory here, so this can come down further. Same thing with the TYX, the 30-year. Down 1.7% after a nice run. Again, up to this 40 level and holding. And finally, let's do Bitcoin BITO. Nice rally today off of this 15 level. getting back above 16, which was the prior. Let's go to the 60-minute chart. You can see that this was the prior bottom of the range, which acted resistance, we broke it, resistance trying to get back above it, did get back above it today. So let's keep an eye on that 16 level. Bitcoin recovering the bottom of its trading range. So those are the big ETFs that we track. Well, let's go two more. Let's go to even weighted S&P 500, down on the day off of the lows from Thursday. Need to do some work here. We don't want to get back below. We need, and look at the relative strength. It looks like the Dow relative strength just really bad, well below uh, where it was back here when price made the lower low. But it really is time for, I know we're talking about some euphoria in AI. It's time for some of these other stocks that are so oversold to get some money flows into them, and that might happen while we rest a little bit during the NASDAQ 100. Then again, the market is always set up to fool the masses. So looking at a failed breakout right here on the NASDAQ 100, equal weight, still showing relative strength. That's a nice setup there. So let's get to the tail of the tape, and then we'll hit the Titan 25. Mixed results there, but nothing to be concerned about. So the news with the debt ceiling reached, gap up is sold. We went from a 2-day up to 2-day up with one consolidation, 2 days above the 8 EMA, 3 days above the 21 EMA. Talked about the big fade. Here are the ranges. Semiconductors and cloud stocks, these are really where AI lives. Big gap up, they faded. A lot of them faded big time. We'll take a look at a couple of them momentarily. IGV, the big software index, still stayed positive on the day, up 0.75%. So in-house, we bought Google on pullback, one of the big AI players. Let's take a look at that chart. GOOGL pulled back, bounced at the 80 MA, reasonably extended from the 21-day moving average. Then we had that idea that we were going to hedge with the SQQQ. So very reasonable to buy it on that pullback. We added to Tesla, showed a nice gap up, held it, and closed above the 200 level and the 200-day moving average. Now it's very critical that it holds today's lows, this 200 and the 200-day moving average level. Going forward, volume has been nice on Tesla over the last 2 days. And they don't all work out. Celsius just fading. We went red on all of our buys with the pullback, and reviewing our sectors over the weekend. Food and beverage, Celsius was the last man standing. Why should it be special? I mean, like every other food and beverage stock that was acting well, has pulled back some very hard. So when you got the sector flowing against you, failed into the 80 MA. It did have a gap up, but failed. We took the rest of it off the table for small losses. We don't want to see small losses turn into big losses. Here was Lulu, our largest holding at 389 back at the beginning of May, and Lulu just completely came apart at the seams, really triggered by Foot Locker's horrible earnings report that trickled through to the shoes and apparel uh, sectors all over the place, and this just hasn't really recovered. Volume has been there on the selling. You get out of the way when your stops are hit or your profits evaporate. So that's not something we want to see happen to our Celsius position. Another position that we have that isn't showing the strength that we would like it to. We're giving it a little bit of a stay of execution here, but Uber, they've had some good news since this attempted breakout over 40, but it hasn't translated into price. We're holding this 37.58, or we're right around that pivot. A pullback to the pivot and to the 21 is completely normal. Don't like the relative strength over the last week, however. So we're keeping a close eye on this. Let's take a look at the rest of the portfolio and then a couple of other hard reversals that we saw in semiconductor land. But bottom line on the day, debt ceiling, gap up, fades. NASDAQ 100 leads, but AI stocks volatile. So let's hit some of those. Well, the rest of the portfolio. First of all, we'll go through CMG, acting just fine, really staying in sync with the market, riding the ADMA. This is our largest position. We looked at Uber DT as our third largest. This is acting pretty well. Got back above that 50 level. Decent, that really acceptable action. In fact, it's acting rationally, and they do have a minor AI component, and this is doing exactly what we would want it to do. DT acting very well. NVIDIA gapped up, was up as much as 7%, reversed at the 420 area, still held 400. These extended stocks that are big leaders are difficult to hold. We were constantly comparing them to other stocks in the past, how they acted, what's a normal pullback, when is it a top and it's time to get out. A lot of the art that goes into portfolio management. Microsoft, another gap up, reversed, but still looks fine. We talked about how we got into Google. We're still holding Meta, and we're still holding AMD. So you can see how several of these names are pretty extended. Wouldn't be surprised to see the pullback. NASDAQ 100 at the close, still 9% above the 50-day moving average. I'd love to see this go sideways for a couple of days. See the ADMA catch up to it. See the 21 and the 50 get a little bit closer. See some sector rotation. But again, what I want and what the market gives me are not always in sync. Let's take a look at a couple that had massive reversals. ABGO. Looky there, peaked out at 922 today. Somebody bought this at 922. It closed. I mean, I don't mean 922 in the pre-market. I mean $922, and it closed at 803. So chasing stocks can leave you with your sucking your thumb curled up in the fetal position in the corner if you don't use proper risk management. One that did not fade is AI. There's a gamma squeeze going on with this. It's massively shorted. They report earnings tomorrow, and this is just a massive short squeeze. Would love to be in it. However, we are not. Let's see what else had a nice day. Palantir. This is heavily shorted also, and is going straight up 50% in a couple of weeks here. A couple of other stocks that had gap ups and negative reversals. They just need to normalize a little bit. They're still leaders. Rambus had a gap up and reversed. ON Semiconductor uh, gap to new highs out of the base and reversed. So keep an eye on these for some normalcy to return into the market. This is very clearly a leading sector. That doesn't make it easy, but it is what it is. Let's go now to the status of the Titan 25. So 17 sectors, 25 stocks. Uh, No surprise to you, green is good, red is bad. This is a little bit of a stoplight report. So what we do here is compare where they are to their 21-day short-term moving average, their 50-day long-term moving average. As long as we don't start seeing all yellow and red here, the market can't come apart regardless of what the doomsayers say. And right now, tech and these top stocks in the NASDAQ 100 and the S&P 500 continue to just rule the roost. On the other hand, the big components of the Dow are more yellow and red, and that's frankly why the Dow has been underperforming. But you can get to the point to where you're just a little too far oversold and you're going to bounce. Would expect that with some of these quality companies that are make up the Dow Jones Industrial Average, and then smaller percentages in the S&P 500. But really, right now, we've got, let's see, we've got 11. This date is wrong. These dates got messed up somehow. This is as of 5:30. We've got 11 in good shape, 8 that are middling, and this is really on a relative strength basis, and 6 that are underperforming. On the 21, we've got 8 that are extended, more than 1.5% above the 21, 9 that are plus or minus 1.5 to minus 1%, one stock that's beneath minus 1%, and 7 that are 2% or more below. Relative to the 50-day moving average, uh, pretty much the same. Slight improvement. You know what? I opened up the wrong chart. That's why. Uh, and uh, from eco, get it, we're one to 50 average. Uh, not change. At least these 25 in stock, hold up, look at our lower. I'm going to wrap up. So remember what we do. Keep clients informed, especially when you're approaching retirement, recognize and help get versus help even in the um, economic sense. It is in certain sectors by far. You know what I'm talking about. I've been following. There's a lot of the market that is extremely oversold right now. We expect this doesn't mean you have to, but we expect sector rotation, improvement on Dow. We always have expectations. We don't make predictions. Those expectations come to fruition, and we take action and to do it. Revere strategy and participate in market will act well. And with that, I will wrap up today, May 30th. To me, as always, love to hear from you. Asset.com, 555 Wealth, 573 or my partner, Dan Stewart, Dan Revere Asset. If you'd like to uh, about giving a client or how much you make in the market, to that you can keep. Thanks for listening. Have a great day.